Hey, Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning, with the stocks to watch and the stock market news you need to see. And Nation, investors are selling their best stocks, not because the business is broke, but because fear is taking over. But for those of you that can look past that fear, that second chance that investors always say they want is coming. I'll reveal my 5 highest conviction stocks, companies dominating growth industries where big picture forces are still intact. These stocks are now at 30 and 50% discounts to their fair value. A trigger is coming for each of them, and you need to be ready. Stick around and I'll also share important news on shares of Palo Alto Networks, PANW, Walmart, ticker WMT, and an update to our stock market outlook. But first, look for the link in the description for some of the best deals on investing sites I use. I use 5 different platforms, some for research, others for trading, but on all of them got free shares and cash back when I open the account. For example, you'll get up to $1,000 in stock with a new account on SoFi. Robinhood gives you a free share, and Moomoo is going to give you up to 60 free stocks on top of an 8% yield on your savings. These are all platforms and sites I've used and totally free to sign up and start investing. So look for the link in the description and get your free stock. Back to the big news this week though, because it might not feel like it, but this could be your best opportunity in years. Stocks in the S&P 500 may only be down fractionally from their highs, but the tech-heavy Nasdaq has fallen 5% from its October peak into correction territory, with growth stocks plunging. Stocks in the Global X AI Tech ETF, the AIQ, are down almost 7%, and the Cloud Computing ETF, ticker CLOU, has plunged 18% in less than 4 months. Nation, it never ceases to surprise me that investors howl for a second chance to buy stocks on the cheap, but then when they do get that sell off, panic and sell out at their best investments. I've been highlighting why 2026 is going to be a very good stock market. Trump's pick for Fed chair, despite what he might say publicly, will be doing everything in his power to lower interest rates. Tax cuts from last year's budget bill will not only save corporations hundreds of billions of dollars, boosting profits, but are expected to increase the average tax refund by over $2,000 to reignite consumer spending. The Fear and Greed Index has swung back and forth from fear to extreme fear over the last few months, but it's only a matter of time before sentiment swings back to greed and pushes up stock prices. And through all this, investors have vacillated from the belief that AI is going to fizzle out, with the money coming up short for that infrastructure buildout, to now the fear that AI is going to destroy all jobs and leave us all unemployed. That's driven a giant buy the dip opportunity in a select few stocks, sell-offs of 19 to 44% in some of my favorites. Now understand, I'm not saying you just bottom fish for the hardest hit stocks, buying those and dream of how much money you're going to make when they rebound, but Nation, it is times like this that revisiting your analysis in those highest conviction stocks can uncover opportunities to double down and make a lot of money. And first up on my list is Shopify, ticker SHOP, the leader in cloud-based e-commerce platforms enabling businesses of all sizes to sell online. This is a market with lots of room for growth, with e-commerce still just 11 to 16% of all retail sales, and Shopify has a strong advantage with 28% of the market, almost as much as the next 2 largest companies combined. That market strength signals a strong competitive advantage in the space, with Shopify leveraging this to revenue growth close to 30% this year and next. That kind of growth is rarely cheap, but we've heard this story before. The company is the dominant player in a multi-decade growth theme, yet investors panic on the short-term noise. Zscaler, ticker ZS, is now down 47% from its peak last year as these cybersecurity names come off expensive valuations and sell off with the rest of tech. Now, you know I'm all about that long-term trend in cybersecurity, with 12% annualized industry growth and much faster in specific segments like cloud and SASE. Not only did Zscaler change the game with its zero trust architecture when it first came out, but it's kept that competitive advantage in some of those growth segments. Now, that sell-off hasn't made cybersecurity stocks dirt cheap, but it has brought them way down from where they were trading at last year. Zscaler books one of the strongest growth outlooks and trades for the second least expensive on a price-to-earnings basis, adjusted for that growth. Folks, cybersecurity spending is one segment of the enterprise that cannot be cut, and ZS is going to continue to ride that long-term growth. Now, Salesforce Inc., ticker CRM, has been falling for longer and is probably my least confident of these 5 stocks, but maybe just too cheap to ignore at this point. Shares plunged almost 30% in just the last few weeks after Anthropic released several AI models and renewing fear that AI is going to put software companies like Salesforce out of business. While that might be true over the next 5+ years, the sell off is overdone and the next couple of years' growth for CRM should support higher prices. Companies aren't all of a sudden going to trust their entire customer relationship stack or their data to AI, and Salesforce is moving aggressively into its own AI agents. Its Agentforce platform has already grown to over $1.4 billion a year in recurring revenue, growth of 114% year over year, and early reports point to strong results for the program, with General Mills tripling its engagement. The company is still expected to post double-digit revenue growth and 13% annualized earnings growth this year and next. Now, Salesforce almost always beats its expectations, so it's only a matter of time before a surprisingly good quarter pushes this stock higher. That longer 3 to 5 year period and beyond may be more uncertain, but I think the next year delivers a strong rebound. Now, Supermicrocomputer, ticker SMCI, is no surprise to make my top stocks list and one of my highest conviction stocks. There are still a lot of bears here, with 20% of the stock sold short, investors trying to push this stock lower, but the numbers just don't lie, and shares will be back up to $50 and $60 each over the next year. That's because if you just put this together, folks, the company controls 22% of the high performance AI server market, a critical piece of the AI infrastructure build out theme. It's a market expected to grow 34% a year to over $800 billion by 2030, with total AI spending reaching into the trillions of dollars each year. So here you've got an industry leader in a booming market, a company expected to post 87% revenue growth this year, and the stock is going nowhere because of that irrational fear in the market. Now, I admit, earnings growth has been the sticking point here. On that 87% revenue boom, earnings are only expected up 8.7% this year as the company competes to take more of that market share. But we could be seeing a trigger point for this stock. The company just beat its earnings expectations by 41% when it reported, and current year profit forecasts have jumped almost 10%. That inflection in earnings that I've been talking about is coming, and these profits are expected to jump to $3 per share next year. The share price jumped 13% on that earnings news. The stock has been dragged back down by short sellers and the sell off in tech, but those earnings prove the stock can bounce higher. Add all this up with the valuation, and you see why I'm holding over 32,000 shares and buying more. On that $41 billion in 2026 revenue expected, which is upgraded just last month, and a market value of shares at $18.3 billion, the stock now trades for just 0.44 times on a price to sales valuation. Even a move back to 1.4 times where the stock traded at last June would mean a 3x return. On a PE basis, so that price to earnings valuation, the stock now trades for just 13 times this year's expected earnings of $2.24 a share, a ridiculously low valuation for a company nearly doubling its revenue and dominating its industry. I have no doubt this stock is going to be back over $40 a share very quickly and likely into the 50s sometime this year, and it will still be cheap at that point. Another one of my highest conviction stocks, one with the upside writing on the wall clear as day, is the iShares Ethereum Trust, ticker ETHA, an easy way to buy Ethereum without a crypto platform. And it's because, believe it or not, folks, tokenization is coming. The process of digitizing an asset's ownership and putting it on the blockchain is really no different than what we do with stocks right now. Tokenization opens up ownership in any asset to millions of investors. Transactions are a fraction of the cost we see in traditional transfers. It brings 24/7 liquidity and transparency, all of these driving forces to this shift. We have just started seeing that shift from tokenizing stocks and the money markets. Tens of trillions of dollars in assets are going to be tokenized, and the Ethereum network is going to be the main infrastructure on which this all runs. But now, just like with SMCI, investors have gotten scared. The stock price falls and investors lose their mind and forget that researching it points to much higher prices. As the price of Ethereum fell below $2,000 each, investors with less than 10,000 ETH, so the smaller retail investors, panicked and sold a combined 233,000 Ethereum. Telling here, though, is that the large and the institutional investors, those with over 20 million invested, took the opportunity to load up, buying over 520,000 ETH, worth almost $1 billion in that first week of February. Those big money investors know something. They see the big picture taking finance into that era of tokenization, and they know Ethereum is going to be there to benefit. Nation, no investment goes straight up, and some of these are extremely volatile. Do your research though, but when that research shows a high conviction buy, then you cannot be scared out of the upside potential, even when the stock drops in a panic. All five of these stocks dominate their industry and have those big picture forces that are going to push this prices much higher over the next few years and out. Now, instead of panicking, take advantage of these sell off opportunities and double down. Looking at the stocks I'm watching this week, first up, Palo Alto Networks, ticker PANW, reports earnings Tuesday, following overall very good reports by others in the cybersecurity space. First, there was Cloudflare, ticker NET, saw its shares jump 14% on the 11th after raising its first quarter outlook, as well as beating analyst expectations for the prior fiscal year. Then we saw Fortinet, ticker FTNT, beat expectations for earnings by 8% when it reported, to see its stock pop by 9% on that day. Against this, the cybersecurity group has sold off recently, even as IT security spending continues higher, with Palo Alto Networks expected to post 15% sales and earnings growth this year. That would bring the stock deep into value territory at just 10 times on a price to sales basis. In fact, a 36% discount to the average price multiple it's traded at over the last year. Are recent acquisitions that keep sales growing, plus a double-digit operating profitability that is best in its class here, makes this one of my favorite cybersecurity stocks. I'll also be watching Walmart, ticker WMT, reporting earnings Thursday, with this stock just not slowing down, up 28% over the last year and almost 180% over the 5-year chart. I have been very bullish on Walmart over the last year and believe it has several levers to pull for that long-term growth. But I do think Thursday's earnings could be a disappointment. Now, the surge in the stock price has taken valuation to historic levels, to 1.5 times on a price to sales, and past 46 times price to earnings basis, double where it's traded at in the past, and really 3 times the valuation on competitor target. Fourth quarter retail sales were less than great, and the first quarter is likely to see more consumer weakness, which could hit the shares if management guides lower. Against that, I am watching for that dip and would be buying into the May earnings announcement, as management should be able to then guide higher on a rebound in consumer spending through higher tax refunds. And Fluor Corporation, ticker FLR, will be an interesting read when it reports earnings on Tuesday, not because I want to buy the stock, but for its read on the economy. Now, I like to use the company as a kind of a leading indicator to economic growth through its engineering, procurement, and construction contracts. From manufacturing to energy markets and government contracts, if the industrial side of the economy starts growing again, you're going to see it first in Fluor and its backlog of orders. And updating our stock market outlook, even with the holiday shortened week, it's a busy week for economic reports and earnings. The next 3 weeks wraps up earnings season with companies reporting a healthy 13% profit growth over the last year. Now we're going to start to see the retailers report, which is going to be an important sign for strength of the consumer, and I suspect it won't be a good picture. Again, holiday retail sales were weaker than expected, and we're starting to see loan defaults creep up here. Companies are going to be updating their first quarter guidance and are likely to use consumer weakness to lower the bar on their earnings expectations. That could help drive that recent sell-off into a correction of 5 to 10% in stocks, so be ready for more pain here. We're also going to see the meeting minutes for the most recent Fed committee meeting, providing a window into how each voting member is thinking on further rate cuts. We already know that members have been split on when and how fast to cut rates, so it's not likely to be any new information. Feeding that into their decision, though, will be the personal consumption's expenditures, the PCE inflation report on Friday. Now, after a lower than expected CPI inflation report last week, the PCE is expected to show similar pricing pressure of just 2.8% from last year. Another moderate read here would be very welcome by the market and point to more rate cuts on the horizon. But then, folks, even without that good news on Friday's inflation reading, the market is setting up to have a very good 2026, even if it doesn't feel that way just yet. The moderating inflation report and the CPI report last week does open the door to more rate cuts and monetary stimulus by the Fed and other federal agencies. Despite the most recent jobs report, employment is still clearly the weak link in the economy, and it's obvious that Fed members favoring rate cuts can use that as an argument to persuade the central bank. And on top of that, as I've been pointing out, we should start seeing a significant fiscal stimulus in the form of tax changes by late March and into April. Tax refunds are already running 10% higher than last year and are expected to be 2,000 more on average. Now that should at least temporarily boost consumer spending, while massive tax cuts for corporations is going to incentivize companies to spend more this year. Nation, investors are just in a pissy mood right now, looking for excuses to take profits. Earnings for the first quarter, reported in late April through May, are expected slightly lower at 11% over the last year, which is why we see a lot of companies providing weak guidance and disappointing the market right now, just to lower that bar, that expectations on their earnings. By the second quarter, though, when those tax refunds boost consumer mood and we get closer to more rate cuts, the outlook is going to improve quite a bit with expectations for almost 15% earnings growth. That upside could start hitting the market when companies report those first quarter earnings and then give their outlook for the stronger second quarter numbers. So I would watch for the market to start rallying into April. Until then, keep some cash available and expect a little more pain in the correction, but be ready to buy back in fast. Get your free stocks and cash back on the investing sites I use. Look for the link in the description for those special offers and bonus cash. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.